Hey, it's Chuck here, and I got some slides today from the Canada Mortgage and Housing Corporation, and I thought it'd be really neat to share some of the stuff with you. The thing about the future of the economy and real estate and everything else is nobody has a crystal ball. I mean, there'd be some very rich people if they could predict the future. There is, however, probability, there's likelihoods, and so here's some of the stuff that the federal government, with all of the research and all their senior analysts, this is some of the stuff that they've come up with, and it's also some very good historical information. So I thought I'd share it with you because I think it genuinely has some real benefit, and not any one of these slides is the answer to the question, how's the market or where's it going or everything else, but they all give little clues. So I'm going to show you what I mean. So the first slide that I looked at, I pulled off, there's probably about 150 of them, and I think I pulled off maybe 18 of them. The first one says the annual change in employment. And we can see that 2012, what they're predicting, the forecast, that's what F is forecast, is going to be a little bit less than this year, but still positive growth in employment. So that's what they believe is going to happen. We also look at carrying costs versus wages. And that's an interesting one too, because we're seeing that the change in mortgage carrying costs, we're almost going to have no change at all. So it seems like it's going to be a flat line in terms of your mortgage as a percentage of your gross income, okay? And then we can see the change in wages is just kind of normalized a little bit. We can see this year it was up a little bit. Average equity accumulated in 5 years. Here's what they're predicting is that we are going to see likely, and you can see that's where we are, okay, and then that's what they're predicting in the future is we're going to start to see a downgrade in equity. And so what that probably means is when the interest rates start going up, which means the economy is recovering, we're going to start to see house prices go down. And I've been saying this for years, and eventually someone's going to listen to me, but that's going to be the prompting that of the changing of the market is going to be when interest rates change, because carrying costs are reflective of how much money you make and also how much you spend as a percentage. The previous one we just looked at. So that's stable, but then we have to see changes when all of a sudden borrowing becomes more expensive. The house prices have to, I always talk about it like a teeter-totter. And so the lesson from this slide is there's a lot of people in the US, and I'm not saying we're heading anywhere near to what the US went through or is going through, but the lesson is that a lot of people whose lesson was put as much money towards your house as possible, they lost their entire life savings from the downgrade in equity in their home. So my advice is your home is part of your investment portfolio. And so what you have to recognize is that don't put all of your eggs into one basket. Make sure that you've got savings. Make sure that you've got your money in other places besides the equity in your home. Because I always look at, like, okay, let's say you have a $300,000 mortgage and you have $300,000 in a liquid account that you could access at any time. In my eyes, your house is paid off. It's not in your mortgage, because mortgage rates are so cheap right now. If you can find anywhere else to put your money, then oftentimes it makes sense to do that. So anyhow, that's just, but a lot of us are hardwired in. Pay your house off as soon as possible. Not always the best idea. Okay, so let's get to the next one. So annual change in number of households. This is a stark reality check here. So this is the future, this line right here. It's a little bit dim, it's hard to see, but we're seeing the 45 to 64-year-olds are going down, and what's happening is they're becoming 65 to 74-year-olds. That's the baby boomers, okay? So we are seeing a tremendous uprise in the amount of retired people or people over the age of 65. From a development perspective, from an investing perspective, anything you can do to cater to that audience, or if you're buying homes that you want to sell in the future, just know that that's going to continue to be a very strong part of the economy. We're also seeing 25 to 44-year-olds, tremendous amount of increase there. And we're also seeing even 75-year-olds. So this, like, well in older people, they were starting to see those even increase a little bit. And that's the aging population. And keep in mind that a lot of our social programs are really going to be under heavy burden because of the aging population. And I know financial planners that specialize and believe that that's one of the biggest things on the horizon in the next 50 years is our aging population, how it's going to affect all of us. Anyhow, let's get into market conditions. Now, you're going to see two different graphs here. So price growth is this one right here. So you can see what's happened anywhere from 0 to 10%. You can see over the last couple of years, we've had a good little run, forecasted at about 8% in 2011. 2012, they're basically predicting a flat line. Okay, so stable interest rate economy. We're probably not going to see a lot of change in house prices. And SNL stands for sales to new listings. So as a percentage of the new inventory that comes on the market, how many of them are selling? And so there's different, this is where it gets into buyer market and seller market, which I hate those terms, but what we're looking at is sales to new listings. We're going to see as a percentage of 100 listings that come out on the market, we're looking at about 55% of them in 2012 versus maybe 60%. So a bit of a change there. And we'll talk about balanced markets. There's another good slide that we'll go over that. Okay, so inventory of singles, very interesting thing. This comes down to affordability. It comes down to a lot of things. It comes down to the demand and what you're looking for. So resale properties, we're seeing a spike up in demand for single family dwellings, and new properties we're seeing less. Now part of that is because HST applies over 400,000, and for most of the GTA, once you cross 400,000, that's when single detached homes start coming out. So very interesting. There's another slide right here. It says new home sales trend. Single detached homes are on the way down. Townhouses on the way up. So if you're looking for where the market is, I think that there's still a good healthy market for single detached. It's still higher than townhomes, but the trend is certainly diminishing, and that comes down to a lot of what we looked at with demographics, with people getting older and then the rise in the younger generation buying their first and second homes. Average selling prices, resale and new. So we're seeing single detached much higher from the builder, whereas oftentimes you can get better value on the resale market. Okay, so the other thing is that townhomes, sometimes you can even find better deals from the builder. My big thing that I always caution people about with information like this, if you have a home to sell, if you buy from the builder and it's ready 12 months or 18 months from now, it's one of the biggest risks, especially with that future looming where our prices could go down. You might find that a year and a half from now, maybe your home isn't worth what it was worth now. And so now you bought a home that's worth less, and your current home that you have to sell is worth less, and it can be a double hit for you. And where people were winning for years and years in Milton and a lot of the GTA was that the other home's worth more and your current house is worth more. So it was just this huge equity stockpile, and it really was like rocket fuel for a lot of people. I don't think we're at that stage in the market anymore. Okay, so actual versus required household income. This is another really neat chart because what it looks at is, so the required income to purchase a home with the max amortization, this is the forecast for 2012, it's come down a little bit. So you're not going to need as much income, probably because of stable or even slightly lower interest rates, but the actual household income is on its way up. Okay, so that's a very good sign, because what it means is that when there's a spread there, it means that people can save more money. It means as a percentage of their income, they're devoting less of it to the home. And that's what we need. And I'll talk about that in just a couple slides. Okay, so the 5-year mortgage rate is at a 60-year low. Tremendous opportunity in so many ways. And you can see in the 80s what happened. That's all the people that said, hey, my 18-19% interest rate, those were the days. And then we've seen that it's even lower than even January 1951. Okay, so debt to income reached a peak. This is a very scary thing for a lot of economists. This is the most scary statistic in all of it, is that Canadians actually owe more money than what they make, some of them, right? So we're looking at debt to income ratio close to 150%. Okay, so that's enormous, and I think I'm hoping that some of the affordability factors we saw 2 slides ago are going to have a positive change on this. We're going to start to see that come back down. 3-year price appreciation for most people living in the 905 region, we're seeing good 10 to 20% increase over the last 3 years. Tremendous stuff. We're even seeing higher in Oakville, Burlington. Vaughan has seen tremendous appreciation. I mean, it's crazy in Vaughan. And Richmond Hill, we're seeing some pockets here more than 30%. Okay, so the most and least affordable areas, what we're seeing is that most of this West 905 area is lower than the median price. That's what we're looking at. So lower by 0 to 25%. The real affordable stuff is obviously really far away, and we're seeing places like Oakville, King. Those are the least affordable areas. All right. So median MLS price. A lot of people say to me, "Hey, I should buy a detached home because it's going to go up faster." Well, look at this graph. I mean, is that true? There's single, detached, semi, row, and apartments. They're all going up pretty much at the same rate. You can see the single, the line is just a little bit up. So if you can get a detached home, it certainly does have some benefit. But there's very, very equal amounts of appreciation for any of them. And what I say to people is there's always someone who wants to buy the 1,300 square foot detached. There's another set of people that want the 1,500 to 1,600 square foot semi for the same price. And there's people that want maybe an 1,800 or 1,900 square foot townhome. And so not any one of those is better than the other. There's pros and cons to both. So just keep that in mind when you're making your decision, and really look at it as being what's important to you. Balanced markets mean prices in line with inflation. So we're seeing inflation hovering at this number right here. That's the purple right there is the annual inflation. Again, pretty steady. Balanced market. There's a lot of stuff happening with this graph here, but this is the MLS price growth. And so we saw at the end of 2008, we saw a bit of a dip, came back up mostly because of low interest rates. And then what we're going to start to see is a little bit of the up and down. And there's a normal seasonality to this too. Their buyers and sellers market, what they classify that as is sales to new listings. Okay, so when there's, again, going back to that 100 listings that come on the market, if we have more than 55 of them that are selling out of 100, what the definition from CMHC, the Canadian Mortgage and Housing Corporation, is that's considered a seller's market. Between 40 and 55% is considered a balanced market, and less than 40%, some of the stuff we saw in 2008, that means that it's a buyer's market. I don't like those terms, but it does somewhat tell you who's in control over the situation to some extent. Okay, so the average MLS resale price, we're going to see modest gains. This is all, this is all statistical analysis is saying, okay, the realm of possibilities, that's where it's going to hit. So it could go lower, could go a little bit higher. We have no idea. Okay, so the newly completed units, this is an important slide for investors. Okay, so the carrying cost for most of these homes is going to continue to rise, but not as fast as the average rent. So for investors, it's going to be harder and harder to get cash flow. And this is from the Toronto Real Estate Board. So this is all the stuff within about an hour, all that stuff you saw on the map. I've been saying for years that Milton is a great place to buy your home. There's a lot of intrinsic value in Milton, but for a place to invest in real estate where you have rental income and all that stuff, I really don't like it. I see very few properties that work. Now, when you look at the Ontario REIN, which is a fantastic investment network, they rank their top 10 towns to invest in, and I'm fully supportive of this. Kitchener-Waterloo, Hamilton, Aurelia, places that are further away, Kingston. These are all, so there's a set of criteria as investors that you look for, and I'll tell you there's a lot better numbers happening outside of Mississauga, Toronto, Milton, all the rest of it. Okay, so there's the last slide is just risks. Obviously, all of these graphs and everything that we talked about are subject to does the growth, is it going to happen quicker? Is it going to happen slower? That is all going to affect the ability for this to happen. So, and there's that, and that just comes down to all the crystal balls have cracks in them, and so it's important to do your diligence to know the expected outcomes within a range instead of trying to pinpoint it. And I hope that some of this information was helpful for you to give you a bit of a sense of where we're going. And I would encourage you to reach out to us if you have any questions about this stuff. Chuck at charltonadvantage.com, or you can call me at 905-693-9346. Have a great day, and we'll see you again soon. Bye for now.